Hello, welcome to our ETF Insights series. I'm Michael Morley of State Street Global Marketing. I'm joined by Frank Kudelka, Global ETF Product Specialist, and Kieran Fitzpatrick, Head of ETF Servicing Europe. We're here today to offer some perspective on the most salient megatrends that have emerged in the ETF space recently and hypothesize about their trajectory into 2021 and beyond. Frank, before we dive into the trends, I'd like to first get your take on how ETFs as an investment vehicle held up to scrutiny amid the challenging market conditions of the past year. Did ETFs perform as you and the market at large expected?
Well, absolutely, Mike. In fact, I think they performed better than I expected. The most prominent example is within the fixed income space. They were tested in March when investors sold off positions in order to raise cash due to the uncertainty after the COVID-19 shutdowns were announced. Generally, the capital markets provide a second layer of liquidity. But since bank balance sheets were constrained, most of that liquidity dried up. As the sell-off continued, investors saw ETFs trading at significant discounts to net asset value. Conversely, although bid-ask spreads widened in most cases, they remained narrower than the underlying bonds that made up the portfolio. This showed the resilience of market makers willing to continue to provide competitive quotes. Still, stories began to percolate in the media that ETFs were broken due to deep discounts and widening spreads. Further analysis showed ETFs working as designed in the volatile market, becoming the true price discovery vehicle of the underlying bonds in the portfolio. It was actually the net asset value that was stale, as pricing and vendors were not seeing regular quotes on the underlying bonds. As days passed, the NAVs began to catch up to the pricing provided by the ETFs. The concern by some that ETF authorized participants, market makers, and other liquidity providers would exit the market during the crisis was also unfounded, as the level of market participants actually increased in March 2020 as compared to March 2019.
Thanks, Frank. It does sound like their reputation really emerged stronger than ever. Now, switching gears to the global trends. One thing we've heard a lot about is the increasing pace of flows into fixed income ETFs. Kieran, do you see this trend continuing?
Thanks, Mike. Yeah, absolutely we do. Just 10 years ago, fixed income ETF assets stood at around 100 billion US dollars. And assets now stand at, or actually exceed 1.5 trillion US dollars, which seems a lot, but this is a tiny fraction of the overall total bond market, which is valued around $106 trillion. So this highlights there's a huge opportunity for ETF growth, specifically in the fixed income space. The ETF investment wrapper is a key component of the continuing modernization of the bond market as well. It takes an asset class that trades opaquely over the counter and migrates it to a transparent on-exchange process. The modernization enables greater pricing and holding transparency, tighter spreads, and the liquidity that on-exchange trading provides. Furthermore, I would say the demographic shifts favors the continued uptick in the allocation to bond ETFs as well. If you look, the global population of retirement age individuals will increase to around 12% by 2030. And if you narrow the focus to Europe and North America, that figure actually increases to in excess of 20%. Investors are expected to expand their income-seeking allocations as a result, and we anticipate fixed income ETFs will capture a significant portion of that demand.
Interesting, Kieran. Now, Frank, I understand there's an initiative in the US that should further improve the outcomes Kieran mentioned. Can you touch on that?
Yeah, sure. More changes are coming in 2021, and they are really positive for the continued growth of the asset class. I like the way Kieran talked about the modernization of the bond market. Here, the US Depository, the DTC, the NSCC, through efforts driven by the ETF Working Group, are in the process of expanding the universe of bond ETFs available for the continuous net settlement clearance process. This process reduces friction in the settlement by minimizing the exchange of securities amongst counterparties and instead netting the settlement to a single long and short position daily. Just as importantly, it reduces the cost of settlement and counterparty risk. All of these benefits should result in tighter spreads and an even better outcome for investors.
Very good. Definitely one to keep an eye on. So the past year can really only be described as the year of COVID, but in many ways, it's also been the year of ESG. Has all the buzz translated into significant flows for ESG ETFs, Kieran? And do you expect there to be momentum into the future?
Yeah, I think that's a great question, Mike. And indeed, the ESG ETF market is reaping the benefits of the buzz, and the momentum is certainly growing. Earlier this year, global ESG ETF assets surpassed $100 billion threshold, and inflows are on pace to shatter last year's record of $27 billion. Currently, for 2020, the inflows are on pace to exceed $65 billion, which is highly significant. ETF investors now have significantly more choice as well, with close to 400 global products added since the first ESG product was launched by iShares in 2002. The type of products include ETFs that screen out certain industries, holistically tilt portfolios toward overall sustainable themes. And also, there's a large number of ETF service providers now providing those products which provide exposure just to very specific themes. But increasing product sophistication is just one of several key drivers that are encouraging this growth. Many skeptics that have focused on the idea of sacrificing returns for ESG are also now taking a second look at the overall ETF ESG market. And if you just take a look at some data compiled by Bloomberg and Morningstar recently, it shows that during the market volatility brought on by the COVID-19 pandemic, which created the economic shutdown, 90% of sustainable indices outperformed their parent benchmark, which is highly significant. The favorability of ETFs as an investment wrapper to provide a transparent and lower cost product also only enhances the value proposition of ESG strategies. And just to note, according to a recent white paper which was published by State Street Global Advisors, ESG ETFs and index mutual funds are expected to rise from $170 billion to $1.3 trillion in assets in the next 10 years, which really highlights how the market sees this playing out. I would just mention there's a couple of other ETF issuers, noted in the media recently, like Amundi and DWS, who are changing the indices under core ETF strategies to ESG strategies, which is going to help them strengthen their position and success in the sustainable space.
Certainly. Frank, what else comes to mind when you think about the major trends in this space?
So one significant shift that I expect will continue is the growth of ETFs at the expense of traditional open-end mutual funds. So right now, they're punching well above their weight because if you look at ETF assets under management, there's less than 8 trillion compared to 46 trillion with mutual funds. So there's a lot of ground to make up. But 2020 has continued the trend of ETFs outpacing long-term mutual funds in net inflows across multiple geographic locations. With the blistering record-setting inflows of over 700 billion this year, ETFs have almost doubled the 360 billion of net inflows to long-term mutual funds. In fact, mutual fund sales trailed in Canada, Europe, and the US markets, with Asia-Pac as the only major region where mutual fund sales have led those of ETFs. There have also been a number of factors, and they vary by region, that have favored ETFs. Some of the global trends have included underperformance of active management, the movement to lower fee investments, and the elimination of many platform fees. The regulatory environment has certainly created tailwinds for ETFs. Global regulators have pushed for added investor protection via enhanced fee and performance transparency, best interest standards, and fee-based versus mission-based advice. While the US market has seen ETF flows consistently exceeding those of long-term mutual funds since 2011, the phenomena has only started going global in the last several years.
Thanks, Frank. On that ETF and mutual fund conversation, a couple of US-based firms recently made waves by moving to convert parts of their mutual fund lineups into active ETFs. Do you think this type of conversion and the growth of active ETFs in the US more broadly signals the beginning of a new global trend?
Well, in the US, active ETFs have in fact punched above their weight in 2020. They've taken in over 10% of inflows, which is 3 times their assets under management, which is 3%. I expect the trend will continue as more active managers enter the space. If you look at the mutual fund landscape today, of the top 10 mutual fund asset managers, all have either entered or signaled entry into the ETF market. These firms are seeing the reduced expense, the improved tax efficiency, reduction of cash drag, the ability to externalize transaction costs, and the exchange trading as key benefits. Many firms are looking towards ETFs as a mechanism to expand distribution reach and provide additional options to the market. But as you noted, others are leveraging the ability to convert existing mutual funds to ETFs. And this allows them to bring along fund track record and scale. Some firms will follow suit given the benefits, but others will opt to have multiple options in the marketplace that include mutual funds. There is complexity involved with a conversion. When you consider direct shareholders, you consider DC plans, multiple share classes, 12B1 fees, and fractional shares. Globally, it's a mixed bag. Some jurisdictions like Australia and Canada have allowed active ETFs with limited holdings transparency for many years, whereas the European Union has signaled opposition due to transparency and investor protections. Well, that said, I would think that it's only a matter of time before these structures or improved versions of them gain regulatory approval and gain traction across the globe.
All right. This was a very insightful conversation. Thank you both for your perspectives. And thank you for taking the time to listen. Please stay tuned for our next podcast on the ETF market and check out our ETF servicing webpage on statestreet.com for more insights. Thank you.